And I want to thank Jeff and Nick and Caesar of the Global Chamber for organizing this event. And Scott Blazer of Crestmark Bank, who will be joining us shortly to talk about equipment finance and asset-based lending. Our goal here today is to expose you to some alternative business financing options that you're not going to hear about at your local bank branch. Just a little background on myself. I started my career in commercial real estate, retail, multifamily development specifically. But in 2009, I decided to sell my holdings and use those funds to start Keystone. Turned out to be good timing because the bank stopped lending to small businesses during the recession, and we were there to help those folks. Since then, we've factored over $100 million in receivables from businesses in almost every state and across a wide variety of industries. So let's get started. That's right. I thought I pushed the right button. You're good, you're good. Okay. My apologies. Here we go. So we'll be talking today about factoring, also known as accounts receivable finance, and purchase order finance. We'll talk about how it works, what the benefits are, how much they cost, how you can qualify, how to choose the right factor or PO finance company for your business, and I'll end the session with any questions you may have. What is factoring? Well, it's simply the process of selling your accounts receivable at a small discount for immediate cash. As a factoring client, you'll receive an advance on your outstanding invoices, so you don't have to wait 30 or 60 days to get paid by your customer. The factoring company will provide you with immediate working capital, and you can use that cash to meet payroll, order supplies and equipment, cover operating expenses, and expand your business by taking on new accounts. Factoring has an interesting history. It hasn't been readily available to smaller businesses until the 90s, but it's been around for a very long time to larger businesses. In fact, it goes back to Roman times. And in the U.S., the first factoring agreement was signed by the Pilgrims of the Massachusetts Bay Colony. It's now a $170 billion industry and growing. So how does it work? Well, the first step that's not listed in this graph is that the factoring company will send to your customer what's called a notice of assignment letter, and that lets the customer know that you're experiencing a tremendous amount of growth and that you're outsourcing your accounts receivable management to the factoring company. It instructs the customer to remit payment directly to the factor's lockbox or bank account via ACH. So, once that notice of assignment is in place and accounts payable has confirmed with the factor that payments will go to the factor, that you can submit invoices to the factor, which will be verified by the factor either through email, phone, or logging on to the customer's online portal for status. They'll then advance up to 90% of the invoice amount directly to your bank account, and then the customer will remit payment to the factor 30, 60, 90 days later, and the factor will then rebate the remainder, 10% if it was a 90% advance, or 20% if it was an 80% advance, minus the factor's fee. And this process can be repeated as often as necessary, even before the first factored invoice is paid. So what are some of the advantages of factoring? Well, a big one is that you can grow your business debt-free. You're selling an asset, your accounts receivable, so there's no interest to pay. The fee doesn't come out until the invoice is paid. There's no equity dilution. You're not giving up ownership or management control to partners or investors. The factoring line is virtually unlimited because every time you add a new customer, the factoring line will increase. It's not like a bank line that caps you off based on your financials, your personal credit, or the assets that you're pledging as collateral. You can pursue larger accounts with confidence because you know that you're going to be paid immediately when the invoice is submitted to the factoring company. I had a client that took his business from about $10,000 a month in factored receivables to $2 million. He really ran with this idea. He's now with an asset-based lender that, like Scott. So that was a good success story for us to have. You could take, for those of you who purchase supplies and equipment, you could really take advantage of supplier discounts by paying them in cash. You're not just receiving funding from an account, from an AR funding company. You're also receiving AR management. It's an extra set of eyes on your accounts receivable, and they could even call your customers for payment status. And they normally have online reports that you can use to check the status of your receivables. They also do credit checks on your prospective clients so you can make better business decisions. A nice thing about working with a factoring company is that they can work hand in hand with your bank so that they're keeping the bank posted on your growth, and when your financials improve, it's a nice handoff to the bank. Again, it's a success story for us. Our interests are aligned in that regard. One of the biggest intangible benefits of factoring is that it reduces stress, and you'll never have to worry about, well, is this check going to come in time for me to meet payroll at the end of the week? That concern goes away with factoring. So the proposal you receive with the rate, there's some things that the factoring company will consider, and that's the average amount of invoices you expect to factor, the creditworthiness of your customer, the particular industry you're in the expected workload. If you've got a lot of different customers with smaller invoices, they might charge you a little more. The factoring fee, it starts to accrue on the day of advance and ends on the collection date. And that rate is normally between 2 and 4% of the invoice for the first 30 days, and then it's divided into 10-day increments thereafter. So if you're at 3% for the first 30, it's probably going to be 1% on day 41 to 50, another 1% 51 to 60, and so on. Another thing to consider is opportunity cost. Have you ever turned away a potential sales opportunity because the customer had longer payment terms than you were comfortable with? Have you not gone after larger accounts because of your concerns about cash flow? And could you increase your sales with existing customers if you were to offer them longer payment terms? Those are things that would pay for the factoring fee many times over.
Did they lower chamber?
Yes. So let's look at an example. If you're factoring a $10,000 invoice, the factor, normally the advance rate is 80%. In certain industries like staffing would be 90%. But they'll wire you 80% or $8,000 within 24 hours. The customer will pay the full amount to the factor, $10,000, 30 days later. The factor will deduct the $8,000 advance in a 3% fee of $300. That's considering 3% first 30 days. And rebate the remaining $1,700 to you. So you'll receive a total of $9,700, $8,000 of which you'll get right away. Could you use that $8,000 advance to increase the sales of your business? So let's say you use that $8,000 to increase your marketing budget and you were able to land another account of $10,000. Even after deducting the $300 factoring fee from your $3,000 profit margin on that sale, you're still adding another $2,700 to your gross revenue that you wouldn't have had normally unless you were factoring. You would normally be sitting on the sidelines waiting for your customer to pay the first invoice. So let's look at a case study here. Gross revenue, based on the last example, you could easily double your sales with factoring. So it goes from $100,000 to $200,000. Now your cost of goods sold increases with the rate of sales proportionally. So you're going from 60 to 120, but it still makes up 60% of your gross revenue. And that stays, and that's the truth with variable expenses too. You can see that you're increasing from 15 to 30,000. These are things like that are tied directly to your sales, packaging, freight, labor costs. But the bulk of any organization's expenses is fixed costs. And those are things like salaries, rent, insurance, taxes. So you can see that that cost remains the same in one column versus the other. And in the left column here, it's making 20% of the gross revenues, whereas in the right column with factoring, it only represents 10%. And because of that, total expenses down here, even though they go up from 35 to 56, they're only making up 28% of the total 200,000 revenue. So the bottom line is that your operating profit without factoring in this example is $5,000, but it goes up to 24,000 with factoring. That's a 5-fold increase, even though you've only doubled your sales. I'm letting you know about this because a lot of people think that factoring is something of a last resort, but it's really a tool that you can really expand your business with quickly. Okay, the customer's credit is number one. The factoring company, the number one thing they're looking at is the creditworthiness of your customer. So it's really suitable for companies like startups that have no financials or businesses with no assets or business owners with poor credit. Yeah, once you submit the application, normally a factoring company gets you a quote in 24 hours, and you can expect first funding within about a week. Subsequent advance requests are processed same day. Who are some good candidates for factor? Really any business that sells to another business. We like to see profit margins of 12%, so it doesn't take too big of a chunk out of your business. Some of the usual suspects are staffing, government contracting, janitorial, wholesalers, manufacturers, oil and gas, IT. It really goes on and on. Special challenges would be retail. That's better suited for merchant cash advance on your credit card receivables. Construction is challenging because of lien laws, but there are factoring companies that specialize in that. Medical as well. There are factoring companies that specialize in that field. Insurance is a little unpredictable. Fresh fruit and vegetable, there's tax laws that make it complicated, but people specialize in that as well. A lot of factoring companies don't like to see that you're only going to factor a one-off invoice, which is called spot factoring. And concentration could be a concern if you only have one large customer. Progress billing is when you're invoicing for phases of a project. That can be challenging. And believe it or not, a lot of factoring companies will factor companies that are in bankruptcy in Chapter 11 with what's called debtor in possession financing. We can also work with companies that have a tax lien. The IRS will usually cooperate with the subordination on the receivables, so the factoring company could be in first position. So how do you go about choosing the right factor? Well, some questions to ask would be, do they have a local presence? Will you have direct access to an owner, or are you going to be assigned to an account rep? Do they have references of current clients? Do they charge an application or origination fee? Are all my customers notified, or just the ones that you want to factor? Do they charge a minimum commitment fee? In other words, do they require that you factor a certain amount per month or per year? Are they requiring a personal guarantee, or is a validity guarantee okay? Do they limit your line based on your concentration? Hidden fees list, it goes on and on, but there's what I've seen in other contracts, monthly maintenance fees, which is similar to a bank. Same-day funding fee, a UCC filing fee, lockbox fee, credit check fees, attorney setup fees, etc. And I want to caution you about a new breed of lenders that have emerged in the last 5 years. We call them merchant cash advance companies or online lenders. They claim to factor, but what they're really doing is tapping into your accounting software like QuickBooks, and they're looking at your average collections and then advancing a loan based on that. And the danger is that they're debiting your bank account on a daily basis at an interest rate that seems low, but it can be as high as 100% a year. So I had a client that decided to go with one of these companies, and now she's bankrupt. So it's a scary thing. What is purchase order financing? Well, the formal definition is a short-term finance option that provides upfront capital to your supplier to fulfill your customer's order for finished goods. It's a little different from factoring. You haven't delivered a product or completed a service yet. At this point, all you have is a purchase order from your customer, and you may not have the money to pay your supplier to fulfill that order. So the PO finance company will come in and either pay your supplier, that's a factory or your wholesaler, cash, or they'll put up a letter of credit to facilitate that transaction. How does it work? Well, you'll receive a purchase order from your customer. The PO finance company will pull credit on your factory or manufacturer or wholesaler. If that looks good, their bank will issue what's called a letter of credit to the bank of the factory, and it's more or less an escrow agreement that says if the product meets these certain specifications and is completed on time, they will release the money from one bank to the other once the product has been inspected and put upon the ship. So the PO finance fee continues to accrue during the shipment process. Once the product is delivered and accepted by the end customer, an invoice is generated, and the factoring company will advance upon that invoice, and the first portion of that advance will go to the PO finance company to pay them off. So it's a closed-loop solution. We had a client that was in the apparel business. All she had was basically sketches of clothing that she sold a line to Nordstrom's, and she was able to do this whole transaction with no cash out of pocket at all between factoring and purchase order finance. So what are the benefits? Similar to factoring, approval is based on your supplier's credit, not yours. So you could be a startup company and still qualify for this. There's quick turnaround time. Normally they can have you approved if you have all your documents in order in a day, and funding is usually within 7 days. There's no upper limits on order size. I've heard some purchase order finance companies go up to $20 million per order. There's no interest to pay because the fee is taken out of the invoice once it's generated by the factoring company. You're able to retain equity in your business. There's no partners or investors involved. And the PO finance companies can offer some valuable advice on overseas trade. They have contacts with factories and inspection companies that they could recommend to you. So how much is advanced in a PO financing agreement? Either 100% of your total cost, but no more than 75% of the PO value. So a big consideration is that the factor's advance on the end invoice must be enough to cover the PO advance and fees. So in this example, if there's a $100,000 purchase order and your cost on that is $60,000, the PO finance company will advance you $60,000. If there's a 60-day delivery time, they're going to charge you 3% per month or $3,600. So of the $80,000 that the factoring company will advance, that $63,600 will go to the PO finance company first, and you'll retain the balance of $16,400. Now, when the factoring company gets paid, you'll receive the rebate. So at the end of the day, you're receiving close to 90% of this amount. How much does it cost? To, typically 2.5 to 3% of the advance per 30 days. If you have a domestic supplier and the turnaround is quicker, they can charge as little as 1.5 to 2% for 20 days. They'll also charge a letter of credit fee. Usually that's 50 basis points on a $1 million purchase order that would only be $500. You may have to come up with a deposit required by the manufacturer. The inspection cost that they'll require you to have, which is also a good idea because you're going to have somebody ensuring that the factory has produced the product for your customer specification, that's between $300 and $1,200. And you're probably looking at a setup fee with a PO finance company of around $300. And also, you know, you want to consider what is the cost of turning down an order. So similar to factoring, if you've got a purchase order that's on the table that you know you can make $50,000 on, but you don't have the capital readily available, why not go through the purchase order finance company to get it done? So good candidates, any company that has a purchase order of at least $50,000, and the PO finance company is looking to make at least $15,000 in fees per year. That's the equivalent of $250,000 of purchase orders throughout the course of the year. You want to make sure you're working with a customer that's creditworthy, that can be approved by the factor, because that's the PO finance company's takeout. You want to work with an established supplier that the PO finance company will feel comfortable with, that's reliable. And you know, we're talking about finished product, not services, of course, and something that doesn't require assembly by yourself before you're selling it to the customer. You're also wanting to do, you know, a reasonable turnaround time from the supplier, because if it's taking 3 months for the product to get from the factory to the customer, you're going to incur a lot of fees with purchase order finance. So I'll open this up with questions from the audience or online.
I answered all the ones I had. Yeah, I had these in my head, and the next slide solved it.
Well, I guess we're good here, and we could turn it over to Scott to talk a little bit about asset-based lending and equipment finance.
Great, thank you. I appreciate your time. Sorry I was a little bit late. I was wandering around here for a few minutes trying to find you guys. There's no one out front, so your guys are tucked away back here. I'm still on vacation mode, so I just got back from vacation. So it's someplace nice and warm. And this is kind of a shock to me to come back to cold weather again, but thank you very much for having me. I'm with a firm called Crestmark Bank. And Crestmark Bank, I'll give you a little bit of history of Crestmark, who we are, and what we do, go into asset-based lending and equipment financing. Crestmark is, we were formed in 1996. We were a Michigan State chartered bank. A lot of people always say, well, you're a bank, how can you do asset-based lending? Well, our charter allows us to finance non-bankable businesses. The only assets or deposits that we accept from people are non-brokered online CDs. We don't offer checking accounts. We don't offer mortgages, car loans, or anything like that. So our charter allows us to finance those businesses that other banks, such as Wells Fargo or Chase, Bank of America, can't do because of any number of situations. Situations can be high growth, some of the situations that Scott mentioned, high growth, leverage, customer concentrations, inconsistent earnings, situations where Wells Fargo is going to say, sorry guys, we can't help you. Would love to help you, but you're just too risky for us from our credit standpoint. And those are the deals that come to me, businesses that are looking for leveraging their assets, their accounts receivable, their inventory, their equipment. And also, I get a lot of times people say, well, you're a factor. And I said, well, we do factoring. That's a small part of our business, but we're more of an asset-based lender. We're more of a collateral asset-based lender. And the difference really between, and I apologize if you covered this already before I came in, is with factoring, you're selling your invoice. With an asset-based line of credit, you're borrowing against your eligible receivables and inventory. So that's kind of the biggest difference. Yes, we're looking at the same types of collateral, but the structure is a little bit different from a legal standpoint, and it's a borrowing situation, more of a borrowing base certificate type of situation. The two products that we have that Crestmark offers on the asset-based lending side is we have a true ABL line of credit where the customer fills out the borrowing base certificate on at a minimum of a weekly basis, or whenever they borrow, if it's more than once a week. And then we have what's called a ledger line. We call it a ledger line of credit, which is also borrowing base driven, but the difference really is we are filling out the borrowing base for the customer. So the business owner is filling out that piece of the information, or we're filling out the piece of information. They're sending us their AR ledger, hence why we call it a ledger line of credit, and maybe the inventory report as well, if we're advancing against inventory in that situation. And so those are the two ABL products that Crestmark has to offer in terms of our customers. When do we use one product versus the other product? It can vary. A lot of times customers qualify for an ABL line of credit, but they like the fact that we're doing kind of the heavy lifting of the borrowing base. We're filling out the borrowing base for them. And they kind of like that idea because that gives the CFO or the controller more time to do other things than filling out a borrowing base on a weekly basis, even though it only takes probably 5 minutes or less to fill out a borrowing base. But that's really sometimes dependent upon the customer. If the company is continuing to lose money, we tend to force them into I don't say force, but we really want them to consider a ledger line of credit because it gives us a little bit more controls and a little bit more, it's more intensive in terms of us controlling their receipt. We're seeing the receivables come in, we're seeing their reports. It gives us a little bit more control, which we prefer over an ABL line of credit where the business is basically we're relying on the business to fill out those reports for us. Also, it could be bench strength. Maybe they just don't have the personnel in the finance department to fill out a borrowing base on a weekly basis, or maybe the sophistication. Maybe we don't feel comfortable that they're sophisticated enough to fill out a borrowing base for us. So what we're looking at is advancing against receivables, very similar to factoring. We advance up to 90, maybe 95%. Typically, it's between 85 and 90 is where we fall. Dilution is always a big part of where we come into in terms of advancing. The amount of the dilution is higher, and what I mean by dilution, and I apologize if I'm covering this again, is any non-cash effect to accounts receivable. So for every dollar you have out there in AR, how much is actually collected? Is it 95 cents? Is it 98 cents? Is it very small, like maybe 99.9% of your dollars collected? That is dilution. Now, take into account any discounts taken, any credit memos that are posted, that affects the dilution number.
Scott, so sorry to interrupt. I'm told that you actually are not visible to the rest of our audience from the webinar. So if you just want to scoot in, maybe you could just...
My apologies.
There you go.
Step over the board. Okay. So sorry about that. Hi, everyone.
Yeah.
So that is dilution, and that's really drives what we advance against the receivables. Crestmark can be very creative if a business owner needs a little bit more availability day one. Sometimes we advance maybe 95% and ratchet down 1% a month down to 85%. So we can be flexible in situations that warrant some flexibility, but typically really our advance rate is going to be ultimately driven by what the dilution is on those receivables. Inventory, when we consider inventory is essentially, we really need to have a perpetual inventory system in place, something that we can rely on, that ties into their accounting software. So if they generate a report that says they have 10 widgets out in their warehouse, there's a good bet that we're going to go out there and we're going to count 10 widgets. So that really, inventory is really driven by perpetual systems and making sure they have good controls on their inventory. Of course, what the inventory is also another factor that we look at in terms of whether or not we want to advance against it. Many times we'll require an inventory appraisal, but not always. It depends upon if they're a distributor, distributing something that's another product of a company that manufactures it. Chances that we're going to require appraisal is pretty slim, but we will look at if there's any returns that we could maybe sell back to the person or the company that they bought the product from is also a consideration. So inventory is definitely driven by those two big factors: controls, perpetual systems, and what the inventory really is. It's probably highly unlikely that we're going to advance against WIP, but like I say, there's always a possibility in our world of financing that if it makes sense, we certainly will. That's one thing Crestmark is really focused on, is if it makes sense and then we can get our hands around it and we can control it, we will probably advance against it. So that's one thing that Crestmark really is an entrepreneurial bank, and that's one thing that we really focus on, is if we can understand it, we can get our hands around it, we can control it, and it's worth something, there's pretty good likelihood we can advance against it and get money for the business owner. And that also includes companies that we don't do progress billing, similar to many factors out there won't do progress billing or construction type receivables. But there are opportunities where we will finance against milestone billing, which is similar progress billing, but it's a little bit more identifiable in terms of what the milestone is. And that also depends upon how good of controls the company has in terms of advancing against those receivables. So really the biggest difference I want to reiterate is it's more borrowing-based driven. It's a borrowing-based certificate type of thing where you have your receivables coming in, you have your collections coming in that deduct from the overall AR advance, and then you place in there what the outstanding balance is and what you have left over, and advancing at some percentage of those receivables. The same with inventory. The inventory, what's been sold, what's in the warehouse, advancing against that inventory. Typically, advances against inventory can range anywhere from 35 to 60%, depending upon, again, what that inventory is and how good of controls there are on that. So that's kind of the biggest thing in terms of borrowing-based driven versus factoring that I want to kind of focus on. Crestmark also does equipment financing. We do everything from just straight term loans against equipment. We do fair market value leases, capital and operational leases on all types of equipment. The only two things we don't like are we don't like things that float, and we don't like things that fly. So we kind of stay away from those two collateral bases. But everything else we do: telephone systems, computer servers, office equipment, restaurant equipment. So that is a very broad base collateral that we look at on the equipment side. Even though on the asset-based lending side, on the bank side, the lines of credit side, we stay away from restaurants. Typically we stay away from technology companies. But our sister side of the business looks at a little bit different collateral than we do. So that, I apologize, I don't really have any presentation material, but I certainly open it up to any questions. Yes, sir.
Do you deal with perishable inventory?
We don't do anything with PACA. We will look at perishable inventory. We have done fish companies that are processing fish. Okay. But we won't do, similar to factoring, we don't do anything that's PACA driven or has any potential for PACA liens. Okay.
And the other one, this actually could be for both of you, is do you partner with perhaps the company's normal retail bank where they have their checking account and they process payment? Do you work with them, or is it separate?
We work with them in that they still need a depository bank.
Exactly.
Yeah. And so, and a lot of when I say a lot, I say probably 85% of my business is coming from commercial banks.
Yeah, okay.
So retail banks like Wells Fargo.
Gotcha.
So my goal is to try to help, if it comes from a bank, is to help that bank kind of keep the deposit side of the business, and I'll take on line of credit side of the business. Gotcha. But yes, we always work with the banks that they're working with. Gotcha. Now there's no, the good news is there's no requirement of any bank. They can work with any bank they want.
Sure.
But yes, we always are working with the depository side of the bank.
What is your minimum commitment size with the clients?
Crestmark is definitely an oddball bank, and with my side of the business, we have a couple of divisions that focus on different types of industries. We have our transportation division that looks at logistics companies and trucking companies, and they also do leases, tractor trailer leases, and they do deals as small as $100,000 for a small owner operator, single, maybe a couple of trucks, what have you. On my side of the business, we tend to like to have fundings of around $500,000. So I don't want to confuse people. I certainly will look at, pretty much any dollar size, but it has to make sense for Crestmark. So I don't want to say
annual figures.
What's that?
Annual figures?
No, I'm talking about monthly borrowings.
Okay.
Yeah, or I should say commitments.
Yeah.
What we have committed. So 100,000 commitment. So our transportation does a lot of smaller deals. My side, I'm not in the transportation division. We're more looking at oil field servicing companies. We do a lot of work in oil field servicing. We do a lot of work in manufacturing, distribution, wholesaling. And typically we're looking at a little bit bigger size. We tend to like to have around 750 commitment, 750 million with maybe $500,000 outstanding on a monthly basis. It's kind of what we like to see. We have a trade services group that does work in the retail space. We don't finance the retailers themselves, but we will finance the product, the people that are selling to the retail companies. Apparel, furniture, glassware, whatever you see in a Macy's or Nordstrom's is, we'll finance those vendors, if you will, that are selling to the retail space. So that's another division that we have at Crestmark. Yes.
So some of our virtual users are asking if you could both maybe give us a success story from your own professional experience. So I don't know if you want to go first, Scott.
Absolutely, I'll be happy to. That's my next phase is to kind of tell you some of the deals that we've done and that we're working with. We worked last November. This was a tougher deal for us as an asset-based lender, and the reason is that they had milestone billing. And what this company did was they did cabling for small companies. Probably never heard of them. Google, Microsoft, Amazon, those were their customer base. So their customers would come to them and say, hey, we're expanding this server center that we have in wherever state, whatever city they were in. And we're doubling the size, and we need you to come in to put all the cabling in, the Ethernet, the coaxial cable, whatever they needed. So they would go in, and a lot of their jobs, probably about 80% of their jobs was they would go in, spend maybe a week, maybe 2 weeks doing their part of the job, and they bill for it. So it was a completed billing. The company would sign off on it, and that was it. 20% of their business was kind of the milestone billing that I kind of alluded to, where they would get a PO from one of their customers. It could be the same customer they do completed work for, but they had 7 items on that PO, and it was for buying material, the rough-in, whatever. There was just 7 items on that thing. So they would do 2 or 3 of those items, and they would bill for it. And then when they would do maybe one other one, they would bill for it to get sign-offs and all that. And so, but the company was very sophisticated in that they were able to identify and segregate those receivables from the completed billings. So they had 2 sets of AR, basically, ledgers. They had the completed ledger, and they had the milestone billing ledger. So we felt comfortable that they had good controls. They had good backup in terms of their customer sign-offs. We could verify their invoices very easily online. A lot of times their customers will have portals. They can go in and see where their invoice is. It's been approved. You can see the invoice has been approved, when it's going to be paid. So we really like the fact that they had good controls in place. So we advanced up to $1 million on those milestone billings. So the company was being asked out of their current relationship because of, well, the last 2 years they grew too fast, and they didn't have the proper controls in place. They didn't have the proper personnel in place as well, and they had 2 very large losses both those years. So the bank that they were with was like, this is just too much for us. So you need to find an asset-based lender. And their banker thankfully knew me and said, hey, is this something you could do? And so we had to sit down with the CFO a couple of times and just kind of really understand how their billing practices worked, what percentages were completed versus milestone billing. And we were able to structure something that gave them the availability, number one, to pay off the bank, but they owed the bank, and also gave them more money day one. And that's what they really needed. And so it was a really nice customer that now we also are doing a lease for them. We're doing an operating lease for them as well. They came to us last month and said they needed some equipment, and so we proposed on doing an operating lease for them. So it's a good relationship. It's a good situation where company went through a rough patch. The bank was understandably not comfortable with them. It made it difficult for some other lenders to understand the milestone versus the completed billings. We were able to roll up our sleeves and really kind of understand how we can structure a line of credit that works for them. So working with another business right now that we're in documentation with, company that basically manufactures distribution systems for solvent that goes into wastewater treatment facilities. So their equipment isn't very large, but it's very needed, I guess. And I'm not going to get into the chemistry of it because he explained it to the owner, explained it to me. I'm like, okay, I'm used to chemistry 101, but this is beyond me. But anyway, they had similar to the situation that the cabling company. They had a rough patch the past few years, break even. They lost a little bit of money, break even, and the bank was like, listen, this is more kind of, this is just not what we do. And so we're able to step in there and provide some AR financing for them and some inventory as well for them. So it's I think about a $2.5 million facility. The cabling company was a $5.5 million credit facility down in the tech center. So those are two good success stories that we're working with. So I'll turn it over to you.
Yeah. A recent prospect of ours was in the medical coding and transcription business, and she started out with maybe $12,000 a month in receivables, and we were able to help her expand her business, and now she's in 5 hospitals in Florida, and she's doing over $320,000 a month now. So it's a smaller scale than what Scott is talking about, but for a small business to be able to grow from that level to $320,000 a month is pretty significant.
That's a services business.
It was a service business, yes.
Okay.
So that was a good one to share.
I've got a question for you both, actually. We're the global chamber. Can you deal with international suppliers or international customers?
We, Crestmark has people like me across the country. We don't have any brick and mortar branches, but we have operating hubs, if you will, where we're monitoring our accounts, our customers, on a weekly basis, sometimes daily. Those are in LA, Baton Rouge, Nashville, Boynton Beach, Florida, and of course, Troy, Michigan, where we're headquartered. We also have an office in Toronto, so I guess you could say we're international. We consider Canadian companies. Okay. Unless they're in Quebec, we don't do companies in Quebec because it's Napoleonic law.
Yeah.
So we are international. We will finance international receivables. We won't finance an international company though if they're outside of U.S. or Canada. But we certainly will finance international receivables. We want to get credit insurance on those receivables. And also they have to be selling to businesses that are known in those countries. And it doesn't necessarily, they don't have to be known here, like Siemens is from Germany or Samsung or what have you. But they need to be, they can't be a mom and pop shop in
Taiwan,
Dusseldorf, in Taiwan or what have you. Right. We won't finance them, but they do, even though they have credit insurance on it, it's, there's a lot of loopholes in credit insurance.
Yeah, collections would be a nightmare.
Yeah, exactly.
Absolutely. Exactly.
Well, we're kind of the opposite. We can finance foreign businesses that are selling to American companies.
Okay.
But if you're a foreign business selling to another foreign business, I do have contacts in the factoring space that I could refer you to if you need help with that.
Gotcha. Scott, so one other question from Scott Smith. Sorry, they're both Scott. If you had mentioned factoring for service businesses, could you elaborate on how that works a little bit more since it's not a tangible product?
Yeah, we actually prefer service-based businesses because there's no disputing whether a product is faulty or not up to the specifications that were ordered. So when a service company finishes their job, there's no disputing it. So we do a lot of staffing, janitorial, security guard. I mentioned the medical coding and transcription services. So that's really our focus, and we prefer to do that kind of business.
We do servicing as well. Similar thing. Even window washers. We've got a company that actually they just refinanced. This is a good success story. We're growing fast. They wouldn't do the skyscrapers, but they would do buildings like this size, 4 or 5 stories and smaller. And he was the gentleman was first generation. His family came over from Honduras, and he started a business. and was taking off like a weed. I mean, he just really was a hard worker, and got to a point where, you know, he was doing about $6 million in revenue, and kind of stabilized there, had good margins, and moved over to more retail traditional banks. So, but yeah, I like window washers too. You know it's done, right? You can go and say, oh, yeah, that's it. Right? Wash those windows.
Any other questions of me? I mean,
Yeah, I don't have any other questions from the audience at this point.
Thank you, everybody.
Yeah, is that
That'll do it.
any closing thoughts from either of our
No, I
presenters?
appreciate the opportunity.
Yeah, thank you.
Feel free. I have my cards with me. I'll pass them out here.
Good.
Feel free. You also check out crestmark.com, crestmark.com. You can learn a lot more about us.
Wonderful. All right. Well, this is Nick Carpenter from Global Chamber. Thank you to all of our participants who came in online. And thank you to both of our panelists.
Thank you.
Thank you.
Thank you.